Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the podcast, my guess is I will cover all angles of real estate, from interest rates to the economy to what's happening in Washington. Anything that affects your real estate or your real estate decisions will be covered here. If you haven't done so already, you can check us out on iTunes. You can subscribe to the show there, search Real Estate 360. If you don't have access to an iTunes account for some reason, you can also go to the website directly and stream it from there at realestate360live.com. Also, there's an Ask a Question button on the right-hand side, so if you have any questions regarding real estate, interest rates, the economy, anything that you would like us to cover on a future episode, we'd be glad to do that as well. Joining me on our panel, as he does each and every week, is Louis Camerosano. Louis, a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's often cited in the media as a real estate industry expert in the Wall Street Journal, Forbes, U.S. News, MSN, CNN, MSNBC, and numerous others. Louis, how you doing today?
Doing grand, Ryan. How are you?
I'm doing well, sir. Thanks for asking. So, we left off our last show kind of giving our predictions for 2015. Obviously we'll see how these play out throughout the course of this year. One thing that I'm actually mad at myself for forgetting to dive into this because it happened that week was we neglected talking about Obama and his plan to basically offer free education for 2 years for college for kids. And I thought this was a huge topic because we always talk about, the whole education system and where it's failing. Now Obama's proposing free community college program where essentially you can go and get 2 years free education as long as you meet minimum standards, which I believe he set forth like a 2.5 GPA. I have a question for you because obviously I know where you stand on this whole education thing, pretty much in the same position as I am. But is it not true that the internet is free? Is it true that I heard somebody told me that the internet is somewhat free?
It's supporting a dying industry, which is the educational industrial complex. I mean, there is no reason for most education to need to occur after you're 18 years old in a formal classroom setting. And it's pathetic, and it goes against two things. One, we've always questioned the value of a college education in today's world. But two, this concept of free stuff. He should give away something a little more valuable than boosting college education, because we've learned over the last 10 years that a college education is not helpful anymore in improving your job prospects. So why? Right. And of course, we've also talked about it's the schools that do help you, the very few schools that do help you get a job are the top Ivy League schools, not the community colleges. So basically, it's not going to get you a job. The idea is that the education or the skills you might learn at the community college might help you get a job. But as you point out, you can get those for free. So why are they trying to boost money to go into something that's inefficient when you can learn all this stuff on your own, online, or even pay an online course? Because they're still far less than going to community colleges. They're just trying to boost the dying industry.
Well, and you know what? And it highlights the point that you and I always talk about. Where we are as an economy, this kind of shows the United States government's hand all over again, because they know that the economy stinks. It flat out stinks. They know it. So they can keep pushing this, this mirage of we're on the rise and we're turning things around, just boost education and jobs will just magically appear, which we know is not going to happen. But these millennials, the supposed millennials that are going to be buying houses, are the ones that, hey, guess what? They should go back to school. It's going to help them in their job search. But at the end of the day, it's just kicking the can further down the road. If they can convince more people that probably shouldn't go to school to go to school and expand out, another 2 years potentially of free education, that just buys us even more time to not have to worry about those people entering the job market.
Sure, but it also increases the deficit, because who's going to pay for free education? Well, that's eventually a taxpayer burden, or you just pile it on to the mounting deficit.
Well, we know that. I mean, this this has been the problem all along, is that their answer to everything is just to print more to spend more, right? It's never, they're not set up as a true business, which is actually figure out how to turn the economy, how to actually allow the economy to grow naturally. They won't allow.
Well, that would be to basically do nothing except enforce the law. So they're not going to do that. Politicians need to be seen to do something, to be doing something.
And QE was essentially what that was all about, was to basically print money, would create jobs, and the jobs that are created, there would then be more money to be able to go back into the economy. And they've showed time and time again that this is a failed experiment. It's a failed experiment here. It's a failed experiment elsewhere in the world. Now our latest event that we have taking place is this week, Louis. The ECB is going to meet, and by all accounts, people are saying that they're going to implement their version of QE. Now, what that means or how much, nobody really knows. But ultimately what I feel like that's going to do is, and people are already baking this in, I would feel that this is going to, have more money pouring back into our bonds and our mortgage-backed securities, pushing basically prices down further. Interest rates in the United States, I believe, will go further if this QE happens. But it's once again kicking the can down the road. This is not a problem. This is not the answer to the problem here. And if they haven't paid attention to the United States and what we've done with QE, why would they assume that it's going to work for them? Well, it's really the only option, right? It's the only option.
Hold on. They actually think it works because all the media and all the propaganda is that QE works and that the United States is the sole bright spot in the world economy because central banks were victorious and that they implemented QE masterfully.
Well, that is true.
That's why they think it's going to work. They actually are brainwashed into believing, or they tell each other, that printing money is the panacea, and the only reason Europe's in the situation that it's in is because they've been handcuffed and they haven't been able to do QE. Now, no one mentions Japan's been doing it for 20 years and it didn't work, and no one's really mentioning that the United States recovery is no recovery at all because they fudge all the numbers to make the GDP look like it's good. They fudge the numbers on the employment numbers to show job growth surging when it's all part-time jobs going to 55 years and older. No matter. So the U.S. economy is the shining example. The IMF called it the sole bright spot in the global economy. So now everyone wants to be like the United States. Massive deficits and QE.
I guess it just, maybe I'm just somewhat jaded here for you and I talking all the time. It's like I assume that other people look at it as we do, but you're right. They're drinking the same Kool-Aid that their buddies are, right? So essentially, they just look at our model and they say, well, look, they're still going. Look at where their stock market's at. They've been successful in averting a financial crisis. And in reality, it's the 1%ers that are able to leverage free money and increase asset prices, i.e. stocks, right? And to a point where everybody feels like everything is just peachy. And the reality is that it's, okay, great. People's 401ks, retirement accounts, their stock portfolios are probably at record highs at this point. But this does not mean that we are in a sound financial position. It couldn't be further from the truth, as a matter of fact. I mean, I read somewhere...
Why do we need a 3% down home ownership buying program if the economy is doing so well?
Because, like we said, beginning in 2015, Obama comes out and now is back on the housing initiative, right? Where he wants to start pushing home ownership again. So now they know that people don't have the money to put down. They know it.
Yeah, if growth is so well, why is Bullard, one of the Fed presidents, talking that QE, that the Fed could resume unconventional policy if necessary? Why is he even thinking about that? If the economy is so well, why does he even have to utter that? Oh, maybe the stock market went down a few hundred points? So he's worried that they know that the whole economic recovery is based on the fact that they pumped all that money into the economy and it drove stock prices higher. They know that. They know that's the only pillar on which they can claim economic recovery. And so they have to preserve that. There's, if the stock market goes down, then they have no leg to stand on whatsoever to say there's a recovery.
Yeah. And
look what happened.
No, go ahead.
No, I was going to bring in Switzerland because we missed a week, and that actually happened, and the reason that the Swiss bank moved to withdraw the peg from the euro was because what we were talking about most likely is because they know that the ECB is going to do QE. And for our listeners, the peg, the euro Swiss peg, was created by the Swiss National Bank, and it was designed to keep the Swiss franc from rising. And the way they did that was they printed francs to buy euros. So over the last few years, the Swiss National Bank has accumulated some ridiculous amount, $400 or $500 billion worth of euro. And it got kind of too expensive, and they realized if the EU is going to do QE, they were going to print even more euro, which meant the euro is going to go down, which meant now Switzerland was going to have to print even more francs to buy more euro. And I think it just got untenable, and it got to the point where it was going to be too expensive that they had to bow out. Now, the thing is, Ryan, they said a few days earlier they were going to maintain the peg. So all these people that were counting on the Swiss franc staying at parity and it had planned their affairs around that, they got shot out of the water because the Swiss franc shot up 30% within minutes of the announcement. And so now what happens is you have the Swiss franc goes straight up because they still have this ridiculous bad balance sheet. They still have hundreds of million dollars worth of euros that are going down in value, but because they stopped doing something they never should have done in the first place, one of the most reckless things, their balance sheet is even worse than the Fed's balance sheet. The Swiss franc gets rewarded for stopping doing what they never should have done in the first place. Similarly, look at the United States. They go on the most reckless money printing experiment in history, 6 years worth of QE. They print $4 trillion. They buy garbage mortgage-backed securities. They buy almost 70-80% of the newly issued U.S. debt. And when they stop, everyone cheers and says, strong dollar. This is where the insanity is that what you do is you go out and it's just like J.P. Morgan. They go out and they do all these nasty things and commit fraud, and then they pay a fine, and the stock price goes up. Right. You know, people are rewarding somebody for entities for stopping doing things that they never should have done in the first place. So now you also have the Greek exit, right? Because that could happen in 2 weeks. And, of course, if Greek exits the euro, if the socialists get in, decide to repudiate all that debt and all the austerity that's been imposed upon them, well, someone's going to suffer there too. Well, if someone suffers, the ECB is saying, well, we might have to cover those losses too. Well, if they have to cover them, then by definition, Switzerland would have to cover them. So Switzerland was probably tired of propping up euro just to keep the Swiss franc from growing too strong. And the thing about the Swiss bank, which is totally different from the United States, if you think about it, at least the Fed was supposedly buying U.S. assets and U.S. Treasury debt. But the Swiss were buying somebody else's debt. Now, I would imagine during that time, Ryan, they were shorting the euro because you can't just have massive exposure to the euro. You know, somebody else's, it's not even your own currency, and they own it. So that whole thing is a disaster, Ryan, and when we talked about at the beginning of the year, something is going to happen. Well, we haven't seen the end of the consequences of this. We've got the Danish have the same issue. They've been supporting the peg, too. Do you think they're going to carry on? They said the other day, we have the tools necessary to support the peg. What tools? The toner and the printing press? At some point, that's going to wear out. The Danes aren't going to be going down the line with the euro and continue to print Danish kroner to buy more euro. So that's going to end. And people are going to get slammed on that, too. You've got all the fallout with the Forex trading companies because of the Swiss. And we haven't even started to see the impact of the low oil prices on the shale oil and the junk bond derivatives. So all this is really, I think, anybody who's just sailing along thinking the United States is some oasis, growing at great lengths and the rest of the world should just emulate it, it's all going to come back onto our shores because the United States is the center of the financial world.
Well, and just for our listeners, to put this in perspective, so in the fourth quarter of 2014, the United States issued over $1 trillion in new debt to pay back the old debt that was coming due. $1 trillion. Okay? Now, since 2000, the year 2000 and today, the global bond market has basically tripled in size. so it's over somewhere around $100 trillion in size. But with the derivative market, that's the backstopping is over like $555 trillion, Lewis, in derivatives.
Ridiculous.
I mean, those numbers are just so ridiculous. I mean, it's inevitable that something is going to crash. But what will happen is that the one percenters will make as much money as humanly possible in the short term, right? And who will get stuck holding the bag as they always do?
Everyone else.
Everyone else. Everyone else. And anybody that thinks that this isn't going to happen at some point. Now, Louis, you and I have talked about that they've been masterful in being able to delay this so-called catastrophe for as long as they have. But that doesn't mean that it won't happen at some point. And I think that everybody starts to buy into that. And that's when it gets really scary to me, because once you have everybody believing the hype, right? And as you can see, the hype has now moved over to the ECB, where they think that if they do the same thing that the United States did, as you mentioned earlier, that they'll get similar results, right? Maybe their stock market will continue to go up and asset prices will rise and jobs will be created out of thin air, and then money will dump back into the economy and they'll be able to spend their way out of this. And it just doesn't work. It just doesn't work.
But Ryan, we said that they can stay in control. As long as they can stay in control, something else didn't happen. Well, what the Swiss did was something was outside of the control, because apparently they didn't tell anybody. Because they knew they couldn't tell anybody in advance. And once you see that, that's kind of every man for himself mentality. They realized this was, they had the Save Our Swiss Gold initiative. They railed against that. They said, if that passes, we'd have to buy gold, and then we couldn't buy francs. We couldn't buy euros to support the peg, so we can't do that. And then they gave up the peg anyway. But the point being was, the Save Our Swiss Gold was supposed to kind of harm them and restrain them from conducting monetary policy, which they decided they're not going to conduct anyway. This is now Save Our Swiss Bank, because they realized they can't carry on, and they did not coordinate this with the other central banks. So once you start to see those cracks, and remember, it's not just Switzerland, it's also Russia and China are not playing along. So if you only have a few of the banks playing along, the ECB, the U.S., and then you have these other events that are outside of their control, that's when they lose control. Because once they cannot control the entire game, then you sue. And the other thing is, what this also does is it highlights to people what can happen to paper assets when you have unpredictable, untrustworthy central banks. They can go poof overnight. If you think about what the Swiss National Bank did, if a company had done that, a company CEO, he'd go to jail. You don't come out 3 days earlier and say, we will defend the peg, and then say, oh, sorry, never mind. And then a 30% rise in the franc, and people who had conducted their affairs around a weaker franc, all the people who had invested money because they were going to export from Switzerland, well, they're done.
Right.
They relied on the promises of the Swiss National Bank, and the point being is people will start to see that's where you lose confidence in central banks is they promised us this. They told us if we did this, this is what was going to happen, and they insisted we were going to continue with this policy. And then they say, oops, never mind, and let the chips fall where they may. And as you say, who gets hurt? The average person gets hurt in that.
Absolutely. And, before you and I came on this call today, Louis, we had kind of talked about, just how predictable everything has become, right? And what you're highlighting there is that the global markets and economy has, for the last 5 years, has been based around there being this predictability of if they say X, this will happen, right? And now what you're saying is that this is like this little hairline crack, right, where now all of a sudden you had one country that has broken from the mold, but now opening it up to where other countries are going to probably start to become deceitful as well, which is not good for the global economy, because now where it was just, we'll just follow in lockstep with what the Fed says and does, now we can't trust every other country that they're going to do X, Y, Z, which is just like ECB. Everybody's predicting something to happen today. Well, it
also shows you cannot continue. What was Switzerland really going to do? They already had 500-600 billion euros. Were they supposed to increase their balance sheet to 2-3 trillion? Just continue?
Right.
Yeah, what they did was the right thing because they finally stopped. But the point is, with any of these money printing schemes, when do you stop? Because when you stop, it hurts. And no one wants to stop. But eventually it has to stop. It cannot carry on. It's just like any Ponzi scheme. Eventually it falls under the weight of its own because they have to continue to pump new money into it. And that's why they've gone to negative interest rates. Because they can't even afford to support the system by paying any interest. Now they want people to pay them money to hold their money so it goes back out into the system. It is insanity that it's lasted this long, but I thought in 2009 or 10, it can only go on to 2012. We had those discussions on the radio show. I actually think this is the year that it really breaks wide open because we see there's two things that have already happened. You have the shale oil, you have the oil price, the implosion there that'll just take a few months to play through, and you have this current ongoing Swiss Franc issue with the ECB going to do QE. Now, they say the QE is going to be kind of, well, it won't be every country will have to buy its own debt. I don't know what that means. That's like doing kind of QE, not doing it on a massive level. Still, it highlights they're not even able to coordinate a thing that they shouldn't be coordinating in the first place, which is QE.
Right.
So yeah, I don't think that the whole thing is going to work because I don't think they have the ability now to paper over all the problems that they created by papering over old problems.
And I agree with you, and I think that, once again, people don't realize the oil debacle is not going to necessarily hurt this month, but it's, 3-6 months from now, right? It's never like immediate. There's always that lag effect, and that's going to take place. Everybody's cheering right now because I'm seeing all the posts on Facebook and Twitter. Oh, I paid $20 to fill out my car. Don't think that there's not, some consequences to be paid on this.
The ship has already hit the iceberg.
Yeah,
and just because the boat is still floating and people are dancing doesn't mean the ship isn't going to sink. That was a massive jolt, those lower oil prices to the junk bond market, for the ability of these companies to pay back their debt, for the banks that have hedged, provided default insurance to these companies, and the Swiss bank thing also. Massive jolts to the system, and the ripple effects are just going to get larger and larger. It's not like when you drop a stone into the water and the ripples go out and they're stronger at the center. These are stronger as they go out. They get even stronger. Because one default leads to another default, and the knock-on effects multiply. They don't dissipate as you go away from the problem. They're only going to get worse as we go along over the next 2 or 3 months.
Well, you had brought up Greece earlier, and just with the anticipation of the ECB meeting, there's already a couple banks that basically came back out and said, they need that emergency liquidity fund again because people are coming in and trying to take all their money back out of the banks. I mean, this is, like as you mentioned, this ripple effect will continue. It's not going to stop. But
it's more than a ripple effect. It gets stronger as it goes on, which is not like the normal ripple effect where as I mentioned, you drop the pebble in the water and the immediate burst is the harmful thing, and then it kind of dissipates. This actually, it sends out the shock waves, and they get stronger as they go.
Yeah, and I mean, everybody, I think, has been conditioned now, and you and I had this conversation before. It was like, okay, so what do we do? Do we not follow in lockstep with what the Fed says and does just because it's been going on for so long, or do we just have to continue to be cautious, knowing that there is this big disaster loom, right?
Well, I think don't fight the Fed was good advice. I think now it's in your best interest to be contrarian and say, I don't believe it anymore. I don't trust it. I never believed it and never trusted what they were doing, but it's obvious that it can work for a while. It's just like drugs. You can say, I don't trust them. You take them and you feel good, or and you say, well, geez, they work.
Yep.
But you know that they eventually don't work. But the thing is, the Fed has managed to keep it up for so long. But now we're seeing that you don't need to be a visionary to see that it's not going to work. It's already not working, and people are ignoring the fact that it's not working because it has worked for so long. They just assume it's going to carry on.
Absolutely, and we have oil prices that have dropped down over 50% And the media gets a hold of it, and it's automatically a positive spin. Now, there's more money that can be dumped back into the economy because people are spending less at the gas pump. They don't ever want to cover the story of, it looks like basically more and more of these places out in the Midwest, North Dakota, wherever, are shutting down. They can't afford to operate at these levels, right?
The media is absolutely complicit in this. Retail sales dropped so during the Christmas season. Now, remember, this is the year, 2014 was the year of GDP growth, solid job growth, and so on. U.S. retail sales dropped. It was the biggest in 11 months. And the Reuters headline, U.S. retail sales dropped, biggest in 11th month, but seen as blip. Blip! You can't get more of a thud of a retail report landing on your desk. It's not a blip. It's indicative that all the nonsense that they've been talking about, recovery and jobs and so on, if they can't even manage, which is not even the sign of a strong company, people managing to go out and borrow money and spend on junk they don't need, but that's how they rate how good the economy is, they can't even pass that test. Lowest retail sales in 11 months, supposedly. Remember, 11 months earlier was during the polar vortex when they used that as an excuse. What's the excuse this time? It was Christmas.
Yep.
In a massive economy. I mean, they have managed to disregard any bad news and managed to pump up any little good news that people actually believe it. And the consumer confidence, I don't know if you saw it, it's like at all-time 10-year highs.
98.2 versus an estimate of 94.1. Now, that was a huge reading. Obviously, now, why would the consumer sentiment be high, though? If you have lower gas prices, people would be. You have lower gas prices, you have a high stock market. I mean, of course people are going to feel a little up on their luck. Hey, look, you got mortgage rates at all-time lows. You got stock market at all-time highs. You got gas prices basically coming back at lows again. Of course, the sentiment could be that, look, we might be moving in the right direction because that's what the media is pumping. But that's not the reality. The reality is that this is just an artificial mess is all it is. And if we had a solid economy, rest assured that there would not be mortgage interest rates at sub 4%. They would not be. They would not be that low. They wouldn't be. Because if the masses could get mortgages, interest rates would be 6 to 7% minimum. Because they would have to be worthy of an investor to lend out money at those levels, right?
And Homes wouldn't be crying a river that their results are poor. And the only reason they had to sell, the only reason they managed to sell the amount of homes that they did was they did it at the expense of profit margins because they had to offer massive incentives to get people into the homes.
Well,
that's not the sign of a good economy.
We talked about this about a month ago when I had told you that I've been watching new home
you
prices.
predicted that's what they were going to do.
Yeah, they were going to come back in line close to where resales were, so it would make it a no-brainer for somebody that's looking at a resale versus a brand-new home. Which one are you going to choose? It's pretty easy, but when they're basically having to eliminate most of their profit just to get the house moved, to get onto their next project or to get out of a subdivision, they're going to do that. And, you know, you and I had
talked. Well, it's the same with the retail sales, right? They had to have 70% discounts and so on. That's the only reason the retail sales numbers were as good as they were. That induced people, which means the companies lose money. They don't make profit margins to get people to buy the junk that they were selling. And it's the same with the new home builders. But they continue to tell us the economy is great.
Well, yeah, it was funny, Louis. A quick little story. So my grandmother saw one of those Black Friday specials was like a 50-inch TV for like $200, right?
Mm-hmm.
So, you know, her and my mom go out, run and get the TV. So I was in charge of setting up that TV that weekend at her condo. And so I get in there, open the box, TV doesn't even turn on, okay? My $200 special, I then look online and look at the brand and everything else. This has been a recurring problem with this TV. So, you know, these type of TVs are just slapped together so they can run specials on them to get people in there to try to buy this and buy something else, right? And it's comical because, I mean, realistically, you know, people are rushing out to get these deals, but it's not like they were out there buying like 5 and 6 things. It's just they go and get one thing, and it's still a blip on the radar, right? Even with giving away $200 50-inch plasma TVs, it's still a blip. It's still a blip. I mean,
a blip that the sales were down.
Right.
Well, that was the other nonsense. excuse they gave was the reason sales are down during the Black Friday was because people were doing so well they didn't feel the need to go out and get bargains. Okay, but what about at Christmas time when after that bargain period, just during the normal holiday shopping season? That argument doesn't apply because if they're doing so well, you would think that they'd want to share the largesse with their friends and family and loved ones and buy more Christmas presents. They didn't. So what's the excuse there? We don't expect this to continue. It's just a blip. Just because they say so.
I know.
I mean, reality is smacking them in the face, and they're ignoring it. And actually, not just ignoring it, they're explaining it away. You know, they've got a narrative to talk about, and that's the housing recovery, economic recovery, and they're going to talk about it no matter what.
Well, you know, and not just were December retail sales, you know, terrible, but then when they revised November, and November was revised lower as well, right? And you know, and this is exactly where we're at as far as the economy goes, is that we will predict that things are going to be much higher than what they're really going to be, and then we'll revise them lower and we'll make an excuse for what happened, and then moving forward we'll blame it on something else, right? Or we'll create another diversion so we don't have to talk about the economy. So I'm waiting, because remember I told you, when we run in these 90-day cycles, Lewis, we had oil, right? We've had now Swiss. There is something coming. It's another diversion that's coming, because we can't continue to have too much focus on the economy. So
no, and the Charlie Hebdo thing was a good one to divert people's attention, to show that kind of unity between all the nations and so on. And we predicted this is the year, though, that a substantial minority of people finally call BS on the recovery. It hasn't started yet. You got this great consumer confidence number. That's because they've been told it's getting better, and it's going to be better. And you're going to see, and this is another prediction that already came true we made in our December podcast. We said this 3% down mortgage program was going to lead to a surge in mortgage applications, so that they can now say, see, 2015 is a great housing year, and there was a surge in mortgage applications. Yep. But we also predicted that what was going to happen? Most of them are going to be denied, but that one, you wouldn't hear about that, and you wouldn't see that in the sales for 3 to 6 months. And by then, they've already created another narrative to convince us that housing is going to do better in the future, the economy's still on track, it's just a blip, or so on.
Oh, of course, and NAR and everybody else gets a hold of it, and they're going to say, housing surge heading into spring of 2015. Don't miss out, right? Don't miss out. I can already see it now. We have low interest rates. We've got rising home prices. Don't get caught.
Solid job recovery.
Yeah, absolutely. Obama's offering 2 years of free school. I mean, it's a perfect time to buy. Perfect.
Exactly.
You know?
Obama's offering cars. He's offering phones. He's offering school. He's offering houses.
He'll pay you to buy a house. It's coming.
Well, that's what it's going to come to.
Right. I mean, because you know what? All those incentives, so down payment assistance programs and all these state-funded programs, it's funny because, like, these things were the ones that were faded out because they were found to have some of the highest default rates, right?
Right.
But now they're being, these same down payment assistance programs are now being pretty much, I consider, overfunded. They're getting tons and tons of money right now. Why would that be? Because they want to basically put people in houses, people that probably shouldn't be buying houses, into them again.
Yep.
Now, you and I highlighted before we came on the show today that it's not the average person, though, that's being helped. It's the new blood. It's people that haven't yet been into the market, so they're able to take advantage. And everybody that's been paying their mortgage on time for the last 10 years, but they're still upside down, we could care less about those people.
Well, they keep paying.
Right. Yeah, as long as they keep paying, they don't care if they're able to move on and buy another house. They're just going to have to stick with what they have for probably another 10, 20 years until they get it paid down to where they could potentially refinance or sell out of it. But I had talked about another looming problem that, nobody's really paying attention to, which is these interest-only adjustable rate mortgages that people took out, 8 to 10 years ago. So I had brought this to your attention, Lewis, that I had a couple clients that called me recently and wondering what they're going to do because they had an adjustable rate mortgage that was a 30-year mortgage amortization, but the interest-only period was for 10 years. Now, some were 10 years, some were 5 years, depending upon what mortgage product you took out. The one specific to a 10-year interest-only period then gets re-amortized after that first 10 years is up on your principal balance over a 20-year loan now. what that means is somebody's payment's could go up $600, $700, $800, $1,000 because they didn't pay any principal down over the first 10 years. Now, if they're in a negative equity position, what would you think is going to happen to that person, Louis?
Ryan, you've identified another issue that's going to occur in 2015.
Yeah.
No one's paying attention to and will be explained away, but at some point you can't explain away people not being able to pay their mortgages, not having full-time jobs, not being able to afford anything but gas for their car.
Right, and you know, it's interesting to me because, see, everybody knew that these interest-only loans were taken out. Now, some of them may have already readjusted, and many of those people may have already been foreclosed on or went through with a short sale. But don't discount.
Not really, Ryan. You pointed out most of them started, you know, the real push to get these interest-only loans started what year?
I would say it was probably 2004, right around that 2003, 2004, and then moving forward.
Through 2005 and 6.
Yep.
So 10 years is really just started.
Yeah, so we got 2000. It's something now. I will tell everybody, if you are in a position and you have, and this is just my opinion, of course, but if let's say your adjustable mortgage right now is 2.75%, it's ridiculously low because the indexes are extremely low right now, and you're looking at fixed rates that may be sub 4%, and you're getting caught up because you're really excited about that low payment, just know that when stuff reverses and that index starts to shoot through the roof, that rate could go, instead of 2.75, eventually it could go up to like 6 or 7%, and you could be caught in a position where you can't, refinance into the fixed rate. So,
right.
Although it may be scary to think that you're going to be making a higher payment, for protection purposes, for long-term play, people that do have some equity in your home, I would highly consider you looking at your mortgage options right now. Rates are at ridiculous lows. Now, I kind of predicted that I felt like they were going to continue to go lower, and I think that they will. I think that they're going to hover in this mid-3 to high-3 range throughout 2015, barring not another catastrophe in the meantime. But all the more reason why you should potentially try to do that. Your payment will go up, but I don't think like it's going to go up as much as what could happen in the future if all these indexes start to rise. You know what I mean, Louis? A lot of these are tied.
That's insurance.
Absolutely, it's insurance. And, I mean, of course, I love a lower payment too. And you could ride it out. If you understand the program, that's fine. But if you're looking for security, long-term security, protecting yourself, then it is probably to your advantage to look at things right now. Mainly because I want to prevent what's happening to a lot of people now when they get caught blindsided. And it's never a reality until you get that bill in the mail where it says, hey, just want to give you your notice. In 2 months, your payment's going up XYZ. And nobody thinks about it.
And this is something you can do proactive. It's not like your insurance premiums that they just hit you with them and there's nothing you can do about them and you can't really protect against it. This is something you can be proactive with.
Absolutely. And I think, especially with housing values, I don't really think values are going to rise this year. I think they're going to be pretty stagnant, if not declining in certain areas. Now, there will be some certain hotbeds, don't get me wrong, and the media will grab a hold of those hotbeds and they're going to push them like that's happening everywhere. Don't be sucked into that. If you really want to find out what your values are doing, you need to contact a local real estate agent, okay? Don't go on Zillow. Don't go on Trulia and assume that number is what your home is worth. I promise you, I have never seen them spot on, ever. Ever. So if you're just looking to find out a valuation, because that's typically what's going to hinge on you being able to refinance or not, you can contact a local real estate agent, have them provide you comparables of houses like yours that have sold, not are active, not are under contract, but have sold in the last 90 days, because that is what the appraiser is going to use when he appraises your house.
And one step further, take that number and then look at the current listing prices that occurred in the last 3 months and see if they've also been reduced.
Absolutely.
That gives you an indication of it, because the comparables are somewhat of a trailing indicator.
Yep, and not to mention that, if we've got a declining indicator, don't think that an appraiser is not going to pay attention to that, right?
Correct.
And on a refinance, much more on a refinance than on a purchase, but on a refinance, an appraiser is more likely to be ultra-conservative on a refinance. They're not going to put their neck on the line when you're doing a refinance. I can promise you that. On a purchase, a lot of times, I've always seen that I felt like appraisers will push the envelope a little bit more. They'll reach for comparables to try to justify a sales price, but on refinances, I mean, I see all day long where the house is probably worth $250 and it comes in at $235 or $230.
Right.
So, and that could be the difference in you refinancing or not refinancing. So before you go and spend money on an appraisal to refinance, contact a local agent, see what you think a ballpark appraisal would be. Have that real estate agent supply you with those comps that were used so that when your appraiser does come out to your house, you have something to give him.
Will a real estate agent provide you with those comps if you're not going to be a client in terms of buying or selling a home, if you're just looking to refinance?
If they're smart, they would, Louis. If they're smart. I mean, all day long, if anybody picked up the phone and called me and say, hey, I'm thinking about potentially refinancing, but I have no idea what my house is worth, could you send that over to me? I'll say, no problem. Have it over to you.
You'll slap that together just to be the local expert go-to guy. Yeah.
Well, yeah, it's more about helping people. I mean, at the end of the day, and the whole reason why we do this podcast is that I hope that even if it's only one person that gets something out of the information that we put out there, that it's going to help somebody make a more informed decision at the end of the day, right?
Oh, that makes sense. We're not making any money off of this, that's for sure.
No. And you know what? If anything else, you and I talking things out a lot of the time, it helps me because when I'm talking with customers on the street every day and I start to pull this stuff together, I can give people a realistic approach, not the media-driven approach that they start talking to me about.
Or the NAR-driven approach, which a lot of real estate agents have because that's what's fed to them.
You know, yeah.
They get the weekly memo. Now's the best time to buy a home, right? Now's the best time to sell a home. Things are looking good. Get your buyers off the fence.
Well, what's interesting, Louis, is that, this podcast is not a traditional real estate podcast. And what do I mean by traditional? We're not hyping real estate every single week. We're not saying interest rates are low, stock market's high, there's low down payments out there. Buy a house now. Buy a house now. Now,
where did we start the program with? We started with the educational program, the free education for college from Obama. We then talked about the Swiss National Bank. We then talked about the Fed and QE. So we realize that those things tie into making a real estate decision, which most real estate agents and most people are oblivious to. They don't see how the whole picture comes together. That's the purpose of the show.
Ironically enough, I have conversations with other agents all the time, and if I bring up anything like this, most of them look at me like I'm crazy. Well, why do I need to know that? And
yes, why do I need to know that? Right.
Yeah, why do I need to know that? All I need to know is I'm looking at the comparables, and this is where the market's moving. This is how many houses sold last month. Where, to me, I could really care less. I mean, I know what's going on locally, but I'm always trying to figure out 6 months from now because we know how these trends go, Louis, right? There are always these lagging trends, and you need to know why what's happening is happening. And for many years, people were so confused. We use the acronym QE. We say QE and we say HARP and HAMP and all these different acronyms people are not used to. But at the end of the day, that was critical to understanding why that was happening, why interest rates were doing what they were doing, and most agents couldn't even explain that to you. QE.
They get the same commission no matter what, though. That's
right, because you know what? NAR and all the other, people pushing real estate will tell you that QE is great because guess what? That means low interest rates. It means low interest rates, which means that you can sell more real estate. But the reality is that there was a reason why QE was continuing. There's a reason why it's still continuing to this day. There's a reason why the EU is getting ready to do it.
There's a reason why it'll come back, too, to the United States.
Absolutely, because it doesn't have a choice to, right? There's pretty much not a choice for there to be negative interest rates and everything else.
That's exactly the point. I was just going to say, the reason they've gone to negative interest rates, they got nowhere else to go. It's not like they're still talking about the United States, everything is on track, and they're going to raise rates this summer.
Yep.
How?
They're
going to have to come up with their excuse not to raise rates and the patience talk, but there's no way they can raise rates when we have the economy the way it is and the fact that everyone else is going negative and printing money. The United States the dollar would soar. They can't allow that. That'll be one of the reasons not to allow interest rates to rise, to actually initiate a rate hike.
Yeah, and they won't talk about oil. Oil won't be the problem. You know what it'll be, Louis, this time? It'll be global uncertainty, right?
Good call, Ron. Yeah, that's the thing. And the United States, is not just an oasis; it's part of the interconnected global community. Blah blah blah, and global uncertainty. We're well positioned to weather the storm, but we can't raise rates.
We don't just make decisions for our country. We're all intertwined.
Yes,
now.
we are the world. We are the world.
Yeah, exactly. And that'll be the mantra. And
Hillary will be president by then, and she can say it takes a village.
Of course. I mean, it becomes so predictable. Anybody that doesn't think like the next 4 years are mapped out, of course, it's got to crash at some point. But their plan is they think that it won't crash, so they can just continue doing what they're doing, which would mean just continue to print money, buy debt. There's never going to be any jobs created like they keep hoping is going to happen. It's just
there
insane.
are jobs created, and they can point to them. They're all part-time jobs. Solid job growth.
Part-time economy.
Yep.
Well,
that's good because, people don't really want to work, so now they're enjoying their leisure time.
Well,
I heard someone say that too. It's actually a good thing. People don't want full-time jobs. Maybe not. Maybe people don't want to work at all. That's true. They still need the money, though, that a full-time job provides.
Well, they got to have money to pay their health care premiums that are through the roof.
Actually, they don't. What I realize is that with your health care premiums, if you make okay money, they're very high. But if you're not making much money at all, you don't have to pay much. You pay a few dollars. You don't pay that much. You don't pay the full freight.
Well, that's not a
so
shot,
you impoverish more people. I mean, you have an incentive to say, well, I'm not going to make that much money anymore. Then I don't have to pay my health care insurance, and then you become a voter for the benefits.
Well, and
once they make it so difficult for people to earn a living, and it's easier to take the handout, then you have a political power because you have more people that are looking to government to solve their problems than just a fair shot and an opportunity. Now look at why you have immigration today. They come to get benefits. They don't come for the opportunity to get work. They come because they know they can get free health care. They can get driver's licenses. They can get stuff. Not because they can go do work.
Oh, no. Are you kidding me? Do work?
Well, but it's hard to do work here because it's hard to get a job. It's hard to keep a job. Employers don't want to hire people because it costs a lot and they have to pay a lot of insurance. And there's a whole bunch of regulations around what people can do at work. So, it's worse in Europe. I think if you had a job in Europe for 20 weeks or something, I don't know what the number is, they can never fire you.
Right.
So why would you ever hire anyone if you were a European employer?
Well,
you're going to make hiring mistakes.
You and I have highlighted that, in this economy, in this market, Wall Street has rewarded companies that aren't productive, right? Now, when I say not productive, meaning that they haven't profited. Now, you and I, Louis, we can't start doing something and not, if we're expecting money, we need money to do it. A free business is supposed to bring in money, but for them, it's not about that. It's about bringing in users. It's more eyeballs. It's more website hits.
Still and true. The perfect example. The real estate market has sales at multi-decade lows, yet those companies make no money at all, have never made any money, have never even really talked about a path to profitability. There's no need to. And their stock market capitalizations are in the multi-billions.
Insane.
It's a perfect example of Wall Street rewarding companies that make no money that are in a fake recovery, which is real estate.
Yep.
Real estate sales, to me, are the only thing they're important. Forget prices. A good market has solid sales, increasing sales, double-digit sales growth. Real estate doesn't have that. Prices are going up, sure. So where's the money going to come from if the sales aren't there? How are these companies, Zillow and Truly, going to sell more advertising if fewer sales are being made? And they don't even make any money. So why do they have multi-billion-dollar market caps? Because that's our economy. That's a sign of a successful business. They're killing it. They're doing great.
Yeah, absolutely. And it is interesting because you're right. Sales would mean, increasing sales month over month, regardless of whether interest rates were 4, 5, or 6%. I think that's key to note as well, right? We can't have sales rising at 3.5%, but even if it was a really good economy, sales would still be moving, even if they were in a pretty good range of somewhere between 3 and 6.5%, right? But
if you look at the housing, they're not there. The sales are not there, even though the rates are lower. They can't go much lower, and sales are still not there. And even though this past year, 2014, was supposedly a big GDP year, a big job recovery year, and yet existing home sales were down 3% year over year.
Well, and I believe it was...
That's all you need to know before you even start talking about recovery.
Well, and then the percentage of jobs, I think, was 40% were coming from energy, which now we have a big problem with the whole oil deal. So
never mind. That's a blip.
We really should just start coming up with our own headlines before they come out and see how close we can match to what they're going to say.
Well, they used the latest word. All you had to use was recovery all last year. Toward the end of last year, they started using the word solid for any piece of economic data. Solid jobs reports, solid jobs gain, solid housing numbers, unexpected if it wasn't solid.
Yep.
But then they'd say, following months of solid this, unexpectedly dropped this month, that kind of stuff.
That's why I said the next two words are global uncertainty. It's coming.
Oh, that's a good one.
It's
Even
coming.
though the United States has had solid economic growth in light of global economic certainty.
Yep, and you know what? They can get away with that because they don't really have to specify anything. They don't have to talk about oil. They don't have to talk about any of it. They'll just throw that out there, and that'll be the blanket excuse for all of 2015. That's I guess.
If people look at the low oil prices as a sign of recovery.
Yeah, and they'd be sorely mistaken because it's terrible. Because
it's temporary too. There's no way that if gas prices stay this low, forget all the horrors you're going to have in the derivatives field and so on. But if they stay this low, Congress will, even Republicans, they will vote for a gasoline tax because we need to improve our infrastructure.
Oh, yeah.
We need to build roads. And so gas prices will go back up, and that whole, quote, tax cut will go away too.
Well, we shall see, my friend. We're up at the end of the show here, Louis, but I want to thank you again for coming on.
Thank you.
Give our listeners your blog so they can check out your weekly blog post, please.
Yes, it's smallgold.com. Please check it out, SMAULGLD.com. There's plenty of charts, graphs, news, analysis on gold, silver, real estate, and they also include the Real Estate 360 podcast in YouTube format. So please check that out at smallgold.com. Thanks, Ryan, and thanks, everyone.
Thanks, Louis. Thank you guys for tuning in. We'll be back again next week. If you have any questions, reach out to us on the website, realestate360live.com. There's an Ask a Question button on the right-hand side. Also, download, subscribe, share the podcast on iTunes. Search Real Estate 360. Until next week.